People are really afraid of inflation right now. But deflation, most people don't even know what it is. And that can be way worse. Hi, I'm Scott Hamilton, certified financial planner, fee only fiduciary with offices in Austin and also in Houston. And we help retirees plan and for a tax efficient retirement. So today we're going to talk about what inflation is. And the quick version is it's simply when prices go up. Your dollar buys less over time. It's insidious. If you keep all your assets in cash, inflation just ticks up over a couple of decades. Your purchasing power is just going down after taxes and inflation. The Fed's target for inflation rate is 2%, and that's one of their inflation and employment. That's their dual mandate you'll hear. But 2% is considered healthy. And when we talk about deflation, you'll understand why. So the recent peak CPI hit 9.1% in June 2022, right? That's the highest since 1981. In the 80s, inflation was out of control, right? And that was a real problem until Paul Volcker and Reagan came in and broke the back of inflation. And then we had a significant bear market, a bull market for the next decade or two after the inflation was beaten. So it's a huge problem for the stock market when inflation's high. Real world, the groceries go up, the rent, the gas, it's immediately felt by a lot of people, by most people, because it's such a visible, it's like a tax. So if the gas prices go up by 10, 15%, it makes immediate impact. So what is deflation? Well, it's the opposite. It's prices go down. Sounds good, right? No, it's not. It's bad. In fact, it's worse. And think about it. When prices fall, people stop spending. And, so why buy it today if you can wait a day, a month, a year, and buy it then? And this is exactly what people do. People operate off of incentives. If prices are going up, they're tending to accelerate their purchases. If prices are going down, they'll extend them over time. And the cumulative impact with 300 million people doing that makes a big difference for the economy. It's a self-reinforcing, and it gets real ugly quickly. So we want to have low, moderate inflation, stable, 2%, ideal. Deflationary situations, bad news. Well, why does inflation feel scarier, but it's not really? Well, because it's visible. You feel it in gas prices and store at the pump. The psychological stress of, well, my money isn't going as far as it used to. Well, you feel that, but you're actually right, because it literally doesn't go as far as it used to. And the Fed has tools to counteract inflation, right? So they can raise the Fed funds rate. They can raise the interest rates, and that tends to cool the economy, lowering inflation expectations, right? So expectations is a big part of it. And as I mentioned earlier about the Volcker, and the rates hit 20% back in the 80s. It was painful, but when they raised the rates, it caused a short-term, really deep depression, or recession, I guess is the right word. But it rebounded quickly. All right, so now why deflation is actually scarier. Okay, so the Great Depression, prices fell 10% per year. Unemployment hit 25%. That's bad. Prices fell. Japan lost a decade plus in between 1990 and the mid 2000s. Deflation took hold, and it cost them 20 years of growth. I think the prices fell something like 65% in total. I went to Japan in '89 with some graduate school buddies, and it was the roaring year. It was absolutely heyday. And the year after, the Nikkei fell and has just recovered to where it was last year, or this year, in the past 1 year. So it's a tough thing. Deflation is scary, and the Fed just doesn't have the tools to counteract deflationary situations. And remember, it's what people expect. If you expect interest rates to go up, that's part of the reason why interest rates go up. If you expect interest rates to go down, deflationary spiral, death spiral, it becomes a self-enforcing concept, and then you end up in a deflationary spiral. That's the worst situation. We don't want to be in that. So the retirement angle, why this matters to my clients. Number one, inflation erodes purchasing power. And number two, it sounds like a retiree's dream, deflation, but it's not, for the reasons why we talked about. I mean, deflation, it comes with, in addition to the cost going down, the asset prices are crashing, houses are crashing, the stock market's dropping. So, if the prices are coming down, think about S&P 500. All the companies are out there. Their earnings are going to be compressed as well, which means the stock price is going to decline, which means layoffs are going to go up, unemployment is going to go up, and there's that deflationary death cycle that's there again. This is where a financial plan can really matter, because once we build the assets, facts, liabilities, and the goals, and we build the model, we can do stress tests on that. We can say, well, what happens if the market goes up? What happens if the market goes down? What if inflation continues on about 2%? What if inflation spikes? Well, what happens if we're in a deflationary spiral? These are all things that we regularly test, in addition to like death of a spouse or a healthcare issue. Lots of variables we can test for. So ultimately, what should you do? Well, you focus on what you can control. You can't control the macro forces. You control your portfolio's resistance. So you can be broadly diversified, global, and invest in hard assets like stocks, right? And those tend to perform better in inflationary cycles. Deflation, there's still diversification is the right answer there, but there's less you can do for deflationary situations. The key is not to trying to predict which way the market is going to go or which way inflation or deflation is going to go. The key is to have a portfolio that has resilience built in that will allow you to not get hit by that train, but you to ride that wave as it comes, right? So please visit the website, Hamilton Financial Planning. We'd love to chat about these or any other issues you have. So another item, we've really worked hard on creating a little pamphlet here. It's 8 foolproof ways to reach your retirement number faster. And it's got some great tips, some illustrated examples. Please take a look at this. Let us know what you think. Thank you.